Can the SBI Life eWealth Plus plan offer both financial growth and life insurance protection all in one to the policyholder? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. So now before analyzing this policy, let us first understand what is SBI Life eWealth Plus plan is about. So this is an individual unit-linked non-participating life insurance savings product, and some of the key features of this policy are twin benefits of life insurance cover and market linked returns, and you have the choice of choosing from two investment strategy: growth strategy and money market investment and active strategy. And you also get a hassle free investment management through automatic asset allocation under growth strategy, and your premium start as low as 3000 rupees per month, and there is no premium allocation charge, thereby enhancing your fund value, and you get liquidity through partial withdrawal from the sixth policy year onwards. So now if you take a look at the benefits available under this policy, there are two benefits. One is the death benefit, which is given to the nominee or the legal heir in the case of unfortunate death of the policyholder before the policy term ends. So as you can see, there are three options on the screen, which is fund value or the date of intimation of death, which is claimed to the company, or sum assured less applicable your partial withdrawal, or 105% of your total premium which you have paid up to the date of death. So out of these three options, whichever is higher in value, that will be paid as the death benefit to the nominee or the legal heir. Another is the maturity benefit, which once the policy matures, the policyholder will get the fund value as on date of maturity in a lump sum as a maturity benefit. So these are the benefits available under this policy. Now let us take a look at the fund options available under this policy. So there are 12 fund options available, which is equity fund, top 300 fund, equity optimizer fund, growth fund, balance fund, bond optimizer fund, money market fund, pure fund, mid cap fund, corporate bond fund, blue chip fund, discontinued policy fund. So all these fund options, as you can see, are categorized based on how much allocation is given to equity and equity related instruments, debt instruments, or like money market instruments, and it's also categorized according to its risk profile, which ranges from low to high. So you can choose options which you feel like this much allocation you want to give, or what kind of risk tolerance you're comfortable with. From based on these factors, you can choose the fund options in this policy. So let's take a look at the two fund management strategies available under this product, which is the growth strategy and the active strategy. So in the growth strategy, your premium is invested through the automatic asset allocation feature, and in this feature the allocation in the equity fund are reduced and allocation in the bond fund and money market fund is increased in a predetermined percentage as per the policy term progresses. In the active strategy, you can choose your fund allocation from the 12 unit funds as per your risk appetite. So these are the two fund strategies. Now let's take a look at the charges under this policy. There is no premium allocation charge, and your policy administration charge will be 100 rupees per month, which will be deducted throughout the term of your policy. And if you take a look at the fund management charges, it differs based on the fund you have chosen, and it ranges from 0.25% to 1.35% according to the risk profile that fund has. So if you take a look at the discontinuance charges, it will be calculated as a percentage of your single premium or fund value. So it varies according to the year of discontinuance. And mortality charges are deducted from each policy month from fund value by way of cancellation of units. So this is charged based on your age and sum at risk. There is also a switching charge, which is 100 rupees applicable for every switch in excess of 2 free switches in the same policy year during the policy term. And there is also something called partial withdrawal charge, which is applicable for every partial withdrawal in excess of 1 free partial withdrawal in the same policy year. So a charge of 100 rupees is applicable. So a major drawback of these charges is, in this plan your entire premium isn't immediately invested in the fund you choose, and these charges are not deducted from the gains you get from the premium invested, but rather first of all a portion is used to cover your various charges, and then only the remaining amount is directed towards the investment. So your principal amount gets lesser, which means your returns will also get much less. So these charges can gradually reduce your overall investment returns over time, which is a major drawback. Now let's take a look at the advantages and disadvantages of this policy. So the advantages are, there are two fund switches per policy here allowed at no additional cost, and the premium redirection will be available only for active strategy from the first year onwards, and partial withdrawals can be made from the sixth policy year or upon the life insured reaching the age of 18, so whichever occurs later. The disadvantages would be, there is a 5-year lock-in period and there is no loan facility available under this plan, and after applicable charges are deducted, only then the net premium is invested. So the life cover provided by this plan also may not be sufficient, and there is no loyalty addition or bonuses available under this plan. So these are also some of the major drawbacks which you need to carefully consider before choosing to invest in this plan. So now, as we have a basic understanding of this policy, let us understand what is the potential returns we can get from this policy, because no matter the benefits or advantage of any given policy, what matters at the end of the day, the returns we get, right? So that's where we are going to analyze the IRR, internal rate of return of this policy. So let's just assume for calculation purpose that a 30-year-old woman invest in this policy with a sum assured of 10 lakhs. So she opts for a 20-year policy term and pays an annual premium of 1 lakh rupees. At the end of the policy term, the accumulated fund value will be paid out. So in the brochure, it illustrates assumed returns at 4% and 8% per annum, referring to the worst and best case scenario respectively. So these scenarios are just for example purpose only, and they do not represent the guaranteed returns or the upper or lower limits of the potential return you can get from this policy. So the actual maturity benefit of this policy will depend on the plan's performance over time. So if you take a look at the 4% return scenario and calculate the estimated fund value, which is at 25.96 lakhs for all these years, which will result in an IRR of 2.42%. As per the SBI Life eWealth Plus Plan Maturity Calculator, which is a return similar or even slightly lower than the rate of interest you can get from a savings bank account. And so this is something which is very low compared to the risk and the time horizon we're taking for this goal. With an 8% return, which is the best case scenario, you can see the estimated fund value is 40.71 lakhs, providing an IRR of 6.37% as per the SBI Life eWealth Plus Plan Maturity Calculator, which is also comparable to a debt instrument returns. So these returns may not be favorable for a long-term investment strategy because this plan lacks the alpha generation needed for effective wealth accumulation. Additionally, inflation will increase the cost of future financial goals, indicating a potential shortfall in achieving the desired corpus. So as you can see, this policy is not giving us the desirable outcome. So what we are going to do instead, we are going to conduct a comparative analysis where we are going to compare this policy with other alternative investments or investment strategy. So instead of investing in a investment cum insurance policy like this, we are going to consider other alternative investment strategy where we can separate the components of insurance and investment to just see whether it can offer us better risk adjusted returns. Because to beat inflation, you need investment that can give you inflation beating returns. So for life coverage, a pure term life insurance policy with a sum assured of 50 lakhs costs 4,300 rupees annually for a 20-year policy term. So this leaves a balance of 95,700 rupees from the initial 1 lakh rupee premium, which can be then invested according to the investor's risk preference. So for conservative investors, debt options like PPF, which is a public provident fund, may be preferred because it is a government-backed product and you get guaranteed returns along with tax benefits under Section 80C. So based on current rates, the estimated maturity value of a PPF investment is 42.47 lakhs with a combination of term insurance. So it gives you an IRR of 6.73%, closely matching the 8% scenario in SBI Life eWealth Plus, but these are guaranteed returns. Here in the 8% scenario of the SBI Life eWealth Plus plan, you are not getting guaranteed returns, or nor are they guaranteed that it will get returns like this. It can even go lower than that because it's not guaranteed. But despite being a low risk debt instrument, PPF offers returns that outperform the ULIP's 8% projection. So as you can see, PPF seems to be a better option considered the policy. So also consider the policy return. For risk tolerant investor, equity investments such as ELSS funds may be a better choice. So assuming average return, the estimated pre-tax maturity value of an ELSS investment is 77.22 lakhs. So after accounting for capital gains tax, the net maturity value is around 70.12 lakhs, yielding a post-tax IRR of 10.87%. So these alternative returns significantly enhance wealth accumulation. Comparing the returns, it's evident that investing separately provides higher returns than the ULIP, accelerating the achievement of our financial goals. So, what is the final verdict now on the SBI Life eWealth Plus plan? Is it worth investing or not? As you can see, this is a typical ULIP providing both life cover and market linked investment options. However, the analysis shows that the life cover offered here is insufficient to meet a family's basic financial needs. Additionally, the returns are also below expectations for a market linked product. So, with high charges further diminishing the overall yield, it also has a high agent commission. So, the insurance and investment aspects of the SBI Life eWealth Plus plan may not be ideal for an investor, and choosing this plan could disrupt your financial goals. So, what you can do instead is, if you are willing to take on market risk, there are other investment options that offer more favorable risk adjusted return. So, for long term investing, it's essential to choose an investment strategy that aligns with your risk tolerance. And for life coverage, you can actually choose a pure term insurance policy, which is often a better cost effective choice as it provides adequate protection at a lower cost, leaving you with more fund to invest in other investment strategies where you feel will give you better risk adjusted returns in the long run.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.